Hi, good morning, friends. A very warm welcome to all of you for joining us for this Analyst Day 2023. Last year, we have met to discuss on the GPS progress. On similar lines, this year we also have Amitabh starting off the session on the GPS. We also have an experience zone at the lobby for you to experience our key digital products. And on popular demand, we have shortened the time. We'll end at 4. With that, I'll sort of now request Amitabh to come on stage and start the proceedings. Thank you so much.
Hi, good morning, everyone. Truly a pleasure to see all of you after a long period of time. Just some quick things. While we have some scheduled sessions and the agenda, I'm sure, is in front of you, it might not cover every part of our business, but just to ensure that you do have access to all of us. There are a lot of management members sitting on this side, and there are also a lot of management. You will see us in burgundy tie. So if you want to see an Axis Bank person, you will be seeing this tie, okay? Rajiv has ensured all of us are wearing it, and people who are not wearing it will have to go back and wear it, right? So if you want to just understand the business better, top 15, 20 people of the bank are hanging around, so please do use the opportunity to talk to them. What I intend to cover in the first 40 minutes is, I think, to just walk you through a story in terms of what have we tried to do over the last couple of years and how it has panned out over a period of time. So we are trying to just hit some key points. Obviously, there are sessions which follow. There are experience zone where you will get to see actually what we have done and why we believe what we are doing there is visionary and it is a 5-10-year bets which we are taking and how the progress we are making in each of those bets. Again, we're happy to delve deeper in any of the areas which you believe you need to ask more questions. So we're not going to bore you with the GPS slide. We're just going to hit straight away in terms of what we believe we have done. The message, it's not a straight line. We have had COVID, we have had some issues, we have discovered things which you are not anticipating, but we have progressed and marched in a certain direction. Maybe not in a straight line, but generally in that direction, and has led to basically a consistent execution. And more importantly, we believe today we have a franchise which is all weather franchise. If there was a cycle, we believe we have a DNA in the organization which can not only survive the crisis well, but hopefully go beyond it. We try to describe that as we today are a crouching tiger. We are very, very careful about what the risks which are emerging in the horizon, what are some things we should be careful about, what we should be watching, what are some of the trends, but at the same time, we're very happy to pounce on any opportunity which comes our way. So we strengthened our balance sheet, one of the best quality metrics in the sector. I'll show you that through slides. We have now risk management and a change in the DNA and the culture of the organization, which is watching risks all the time. And we believe that that gives us the resilience through various cycles. We believe we have delivered on the deposit quality, and I'll show you matrices around that. Deposit composition is witnessing very clear, visible improvement. Still some work to do on the deposit side. There's a specific session on deposits, and I'm sure you will have a lot of questions, but we believe we have made a lot of progress there also. We have lifted the growth momentum across various businesses, and again we'll show you matrices. So it's not only just about solving some of the problems we have had, we are also now across various matrices, across various businesses, are building our franchise. We have changed our market position. We are making more money as a result. Our profitability in each of those businesses has improved over a period of time, and we believe as we continue to execute well, you will see that across more and more businesses of the bank. We continue to build scale and create significant value in our subsidiaries. A lot of the subsidiary CEOs are also present, so you can have a discussion with them through the day. And that was one of the key matrices we had highlighted and talked about when we started the GPS journey, that we want to scale up our subsidiaries. This is a point which I made last time also, that while you do transformation projects or changes in specific businesses, it has impact in that particular business alone. When you start doing projects and things which, like One Axis or partnerships or the technology platforms which we have created, they impact multiple businesses. And we believe that we have planted seeds of multiplicative forces in the bank, which will positively impact large parts of our businesses and many businesses at the same time. We are self-sustaining capital structure. We are accreting capital after a long period of time. And again, I'll walk you through a slide about that. We had started increasingly talking about areas of distinctiveness. We call them 2+1. We have best-in-class today, we believe, very strongly, best-in-class digital capabilities, and it puts us on a path to become one of the best digital banks in the country. Again, we will showcase to you what we have done. There is a presentation on the digital side, so I don't want to take too much away from there. We have inherent strengths in Bharat Banking. Over the last couple of years, we've put in a lot of things in terms from a platform perspective, and we believe now we have the right to win in that marketplace. Sparsh, which is our customer obsession project, and Siddhi, which is the super app, which is enabling all our employees and has been rolled out now to more than 30,000 plus employees, we believe will set us apart in the next decade. Each of these things is not something we have done overnight. What you will see when outside and what you will see people discussing today is invariably a 3 to 4 year journey we have been on. And by the way, the journey has not stopped because in many cases, the first version of the journey is not over, and wherever the first version is over, we have already embarked on the second version of the journey. So it is creating a gap between us and some of the others, when especially you see what kind of stuff we are doing with some of those applications and our, say, customer obsession projects. In terms of differentiation, we believe we have a premier customer franchise across wealth and cards, and there is a session which will talk about that as to why we believe we have a premium franchise and how the numbers have moved over a period of time. We have one of the most, perhaps the most comprehensive wholesale banking franchise, which is a combination of the bank itself and some of the subsidiaries we have. And we are very, very focused on granular, risk-adjusted, high-yielding segments. And there is a slide I have later which will show to you as to how our market share in those focus segments within our overall balance sheet has changed over a period of time. So what I'm really trying to say is that whatever we have achieved till now is part of a calibrated strategy. In many cases, substantial improvement has been made, and it is evident in the matrix. Don't just believe what I'm saying. In many cases, the journey is on, and we have some matrices which show progress, but still there is some distance to cover. We are not shying away from that whatsoever. So very quickly, moving on, just trying to show a comparison in terms of where we were in financial 19 in each of the key matrices and where we stand today as of financial year 23 and first half. You will see our advances in deposit market share, our operating revenue growth, what it was in financial year 19 and what we have recorded in the first half and financial year 23. If you look at consolidated ROE, that's a number well known to you. NIMS, there is a clear improvement. Core operating profit growth has moved up to 19-20% range. Our CET1 ratio is looking much better. Provision coverage ratio has moved to the 79-80% range, and our net NPA has fallen to 36 basis points, which is perhaps the best in the industry. We believe that we have now surpassed some of the aspirational targets which we had talked about when we launched the GPS strategy. And you will see the reason we are putting up these numbers is that there is a journey which we have made here. And in some cases, we obviously want to maintain it at those levels. In some cases, there is still some scope for improvement. And we'll obviously continue to work on that as we move forward. We always talked about ROE as something on the top of the house of GPS. If you look at our ROA, it has moved to consistently 1.8%. Our ROEs have now jumped to 19%. We do have, and we have delivered 18% ROE now for the last 5 quarters. Obviously, that's a huge movement from our perspective. The RWA intensity has also held steady while we have delivered it. So it's not that we are delivering this ROE because somehow we are taking more risks. I think we have delivered this ROE while at the same time ensuring that that our overall RWA intensity remains the same. So we have pivoted to better quality. We have pivoted to more retail where RWA intensity does not help you. And in spite of that, we have delivered that higher ROA. And that goes back to the original statement I made that as we have scaled up our businesses, we are seeing more profitability come through in those businesses. We have obviously seen the NIM improvement, and that is what is feeding this ROE rather than just taking more risk. Actually, the bank, across most of its portfolios, has moved to lesser risk rather than higher risk. Continuing on, if you look at the gross and the net NPA ratios, you will see our PCR has moved up 2,700 basis points since March 18. Our NPA has reduced by NNP is reduced by 304 basis points, and gross NPA ratio is the lowest in last 30 quarters. Our net NPA ratio is the lowest in last 41 quarters. And we have also tried to do a comparison with the Peer 1 and Peer 2 banks. You can very quickly make out who they are. Our net NPA ratio is best in class. If you look at the retail portfolio, which seems to be the focus for everyone, even on the retail side, if you look at the gross retail NPA for the large banks, we are doing quite well. And it's not only now, if you look through the COVID times, that shows more difference between us and them. It is not that we are today at that level. Through COVID times, we did extremely well. So I know some people worry that when we get tested through a cycle, what will happen? COVID was, in my mind, 2 sharp cycles. But in those 2 sharp cycles, we did quite well in comparison to the banks we get compared to. Moving on. The point I want to make here is that this is not because suddenly we have tightened the standards. I think we have worked very hard to change the DNA of the organization, the rigor, the frameworks which we have to manage risk for the bank. We have conservative policies, we have conservative risk guardrails, we have constant monitoring, we are using various algorithms to ask ourselves the question, is there any signs of development of stress in the system? We are proactively looking at how we can use data to catch problems before they actually surface in the data itself. So what are the other data which is available in the system which can tell us something? There are a lot of changes that have happened. And by the way, in most of those changes which we have made, it is not necessarily in the hands of individuals to take more risk. It is calibrated. In many cases, it is formula driven. You cannot play around with it. So because of this change in DNA, I believe that Axis Bank is now a different bank in terms of how we're looking at risk, how we assess risk, and what are the kind of risks we intend to take going forward in the future. It's not that we are not working with the fintechs, but when we work with the fintechs, all the underwriting is done by us. We are not relying on anyone to do the underwriting for us or surface the data the way they want. We look at all the data, we decide what we have to underwrite, and we are happy that the yield rates might be lower in terms of what actually gets approved. So that mentality is very, very clear in the system. We have also strengthened our capabilities on the cyber security and operational risk side, given the growth aspirations and investments you're making. We have a presentation on technology. You will get to see some of the work which we're doing there and how we're managing some of these areas. I just want to land that point that yes, we're looking at some of those risk areas also very, very actively. It's an important slide. I know all of you question us on deposits. We are growing faster than the industry, point number 1. Point number 2, it's a very important point because you will ask the question, what have we been doing for the last 4 or 5 years? Apart from delivering better than industry growth, one of the things we're very focused on is we want to reduce the outflow rates and look at the data of the outflow rates of the top 3 banks. We were the highest at 28.7%. Over the last couple of years, we have brought it down to 23.2. We are better than the best. And that means very clearly that it has an impact on your deposit growth because you are asking some of the people who have been your traditional depositors to go away because you don't want that deposit because they have high outflow rates. So it is not just about reducing the outflow. It is also about changing the way you go and garner deposits. 550 basis points change is not a small change. It's on the entire stock. It is not incremental. It's a big change. And thirdly, if you look at the ratio of CASA to assets, we are doing quite well. So we again, we'll obviously have a detailed discussion on the deposit side and what exactly we're doing there. But I do want to land the message that a lot of work has happened. A right platform has been created. And as you do that, and as you change the nature of the organization, there were only a certain part of the organization which was garnering deposits. Now the entire organization is gradually being pushed to start garnering deposits of the right kind and do it consistently. Continuing on, we have lifted the growth momentum in the identified areas of business, and I'll explain the slide in a minute. If you look on the left-hand side, we are just saying that the total bank advances have grown by 15, but retail has grown by 17, SME has grown by 19, and wholesale side, where the, let's say the NIMs are lower, or where if you're not getting the right redox, has grown only by 9%. Now, when you go to the right-hand side, for example, on the retail segment, right-hand side top, you will see that in the identified segments of our business, our growth has been much higher. And the same thing applies to the wholesale segment also. You have yield on the bottom and the growth at the top, so you can relate to it. So we have grown by 24% in the focused segments. There's a 40% proportion now in our business of focused segments. And we have 950 basis points increase in the focus segments. It has not happened just like that. It is part of a focus strategy that these are the businesses which give us better NIMs and REDOX. This is what we want to focus on. And over a period of time, you will see the change that has happened. Now, because of this change, it obviously reflects in your P&L over a period of time. And this journey is not yet over. And that is obviously contributing to the quality of our earnings. If you look at the RWA growth, our RWA growth has been the lowest. But at the same time, if you look at how the credit RWA has moved, pretty consistent. If you look at the typical way of looking at standalone ROA or standalone risk-weighted assets, the chart speaks for itself. It is not coming at the cost of higher risk. We are growing in these segments while ensuring that the overall risk profile does not change. In many cases, actually, we have improved the risk profile. We have been shouting from the rooftop that if you look at our wholesale segment, more than 85%, 87% of our business is A and above. And by the way, it's not just for the sake of saying A and above. We also check our internal ratings with external ratings. And we have rules in place which do not allow internal ratings to be better than external ratings. Unless there is a collateral which, cash or something like that, which allows us to give it a higher rating. So it's not just made up, it is reality. And our NIMs are improving. Now you will say through the cycle, so we have actually put it up front. There is a 25 basis points improvement in NIMs through the cycle. It is not just because of the fact that, the rates have gone up, so we have taken advantage. Yes, all of us have taken advantage of the fact, but through the cycle, they've gone up by 25 basis points. There is a 17% increase in NII, 17% CAGR growth in NII. You will look as retail as a percentage of the loan book, non-NIR, how it has come down, and we also reduced the share of low-yielding RWA bonds. So all these are obviously feeding into the NIM story. And granular fees is now one of the best in the industry. We have again compared ourselves to some of the other banks and how do we fare there. We have shown the growth to you. You can look at the numbers. 94% of our fees today is granular retail and transaction banking related fees. There is no more one-time fees which is hidden in those numbers. It's all granular. There is a 600 basis points improvement in the granular fees. And there's 16% growth in retail fee CAGR. Again, please just look at, when I'm telling you all this, please look at the last 4 or 5 years journey and see the change. Sometimes we just look at year-to-year change, just a quarter-on-quarter change. I'm asking you to just look at the snapshot of the last 5 years and how things have moved over a period of time. And why, if we keep doing certain things, some of these numbers can move up further. Puneet is not a guidance. Where is Puneet? Okay. It's not a guidance, Puneet. He'll kill me tomorrow. We said we'll scale up the subsidiaries. We have shown you all the subsidiaries and you will see the data there on GPS, how the growth has been, how the profitability has improved and what the ROE is. You will also see that while we have invested close to 3,000 crores in our business, today the net worth is about 7,037 crores, 27% improvement in the combined net worth and 53% return on investments. So subsidiaries are scaling up, huge scope for them to continue to grow. But overall, the scaling has happened. We believe it will continue to happen. In some cases, we are changing the profile and the kind of management team we are putting in place. And we are extremely confident that as One Axis continues to feed into each other, each of these subsidiaries will only gain from here. Again, part of that same GPS strategy. Everything is connected back to GPS. We are showing you nothing which we had not said in our original GPS presentation. We believe, and I think some of the speakers who follow me will talk about it, we are now creating a unique position for ourselves in the partnership model. I've shown you some examples. I think Samir in his digital presentation will talk about some of the more partners. All the partners who matter today in the ecosystem, the wide ecosystem out there, want to or are working with Axis Bank. It's a combination of technology, it's a combination of what you will hear some of the partners speak, which is unique and which is allowing us to win partner after partner after partner. We believe it's an important distribution channel for us, and it is not restricted to a product, it is multi-product, it is across various markets, it's not a partner of only a particular kind, we are partners of all kinds, attacking all customer segments. And one of the important points from a technology perspective is that I remember when I joined the bank, we had 5 APIs. Look at the number of APIs we have now. And why it is easy for partners to connect with us, why they want to work with us. Because once they decide to work with us, we have all the things in place. You will hear about more other things which we have in place. So, let me leave it to Samir to talk to you about it. I talked about the multiplicative forces. And some of the things we talked about is digital, our partnership model, the Citi franchise, and how it is feeding to the overall scheme of things. Our universal underwriting and personalization. Balaji will talk to you about personalization, what are some of the transformation projects we undertaken, and Bharat Banking. And you will see some of the matrices. We've thrown some matrices at you on the right-hand side in terms of how it is helping our overall franchise. Because, for example, if you get the partnerships right, it is feeding on the retail assets, retail liabilities, and on the SME side. That's what I mean by multiplicative forces. You're not doing just one thing. When we talk about Citi franchise, it is again feeding into our Burgundy Private, our cards franchise, our assets franchise, and obviously as we engage with those customers, it feeds into the wholesale franchise and our subsidiaries also. So some of these things are multiplicative. And that's why we are pushing some of these 3, 5, 8-year projects very, very strongly within the system. If we can get, for example, our customer obsession or the NPS score right, and we'll show you some data, customers on the street, we want customers on the street to say that Axis customer service is the best. And that will make customers come to us. And that's what we want to achieve. So we'll show you some data on that. We today have a self-sustaining capital structure, resulting in value accretion for all stakeholders. You will see that in the first half, we added 54 basis points. We have additional cushion of 48 basis points coming out of our COVID provision. We have no intention of writing it back. So that's an additional cushion which is available. And obviously, the glide path very clearly shows to you how we have added capital and where we have consumed it. And that has happened after a long period of time where, in spite of the growth rates we are recording, we are accreting capital in the franchise. So the bets for the decade and beyond, we want to create the best digital analytics franchise, which we believe will put us on the path to the best tech bank. It is not based on some words. We have gone and done a very detailed exercise to understand what is happening in the world, where people are doing a great job on the digital or the analytics side, where we are pretty much on par, what are the gaps, and what we need to do to bridge those gaps and go beyond it. It is not some words which are put there on the slide. So in each of these things, there is a 3-5-year roadmap which is in play. Because it can't be done overnight, but it is in play. And we believe because of some of the stuff we are doing, we have the opportunity to become the best digital bank. The launch of Open was part of that strategy. It will be obviously part of Axis Bank, but we want to create a brand out there, which is again linked back to Dil Se Open, which we've been talking about for quite some time. And again, Samir will tell you a little bit more, and Balaji will tell you a little bit more about digital analytics capabilities. We believe we are in a sense in Bharat Banking. We have a Bharat Banking session. And Sparsh and Siddhi we talked about. Just to give you some matrices, if you look at deposits on a base of 100 as of first half financial 23, we are at 154 in our digital side, and on the loan side, we are at 177. We're the first to go live on account aggregator framework. We're the first bank to launch the CBDC merchant app. We're the first bank to go live on RBI tech platform offering credit for MSME loans. Today accounts for 5% of overall business. We obviously want to build it 3-4 times more by fiscal 2027 because all the elements are in place. It's a question of how do we build that up from here on. If you look at the analytics side, we are the first bank to be certified, ISO certified by AWS and Azure Cloud. We are the first bank which will be rolling out MS Gen AI Copilot. And you will have someone from Microsoft talk about it. We have an 800 bit site rating, one of the highest in BFSI space. Today we have 15,000 nudge variants. If some of you have Axis Bank account, you see that on a mobile app. We today have 3,000 plus attributes on 4 crore customers today. And so we can do a lot of things with it. And for example, just to give you one data point, just because of nudges, we have seen 1.6 times, lift in terms of the term deposits and what are they being opened. So wherever the nudge has been given, we have seen a 1.6 times lift. Today we have increased our cross-sell programs at 1.5 times, 50% increase in retail disbursals, and about 10 plus alternate data sources and models are live now. And the journey in my mind has just started. Bharat Banking continues to play well. We are close to 2,400 branches now doing Bharat Banking. We talked about the 63,500 VLEs. We have, again, partnership is an important model for Bharat Banking. So we have 75 live partners. We have delivered strong growth across each of our businesses. And now we are working, once we set the platform, as to how we can take it to a completely different level. Some of the other matrices in terms of quality are right there before you. An important point, we got RIDF bonds, we are not meeting PSL targets. For the last 3 years, we have met PSL targets. One of the important elements of Bharat Banking has been to ensure that we come and meet our targets inside of Axis Bank. We have seen 63% increase in overall PSL penetration since financial year 21. So that movement has also happened. You will sparsh, there is a 25% improvement in the external NPS score. I think external NPS score to some extent reflects what people think of the bank and not necessarily the experience. Our ranking has moved to 3rd. But if you look at we are obviously hoping to get more and more customers as promoters. But if you look at the internal NPS movement, and obviously this is again governed centrally and no one can play around with it, we have seen 39% increase in the retail bank NPS and 33% in the wholesale bank NPS. So we are seeing clear changes coming through. And again, we'll highlight to you some of the things which you've done there. On our Siddhi app, as I said, we have 30,000 internal employees who are using Siddhi today. 70% of the retail business is covered now by volumes, and today we have 18 product journeys, and we'll talk about this app and what we're doing there. There's also, we are showcasing it outside. 1 in 3 richest Indians is our customer today on the wealth management franchise. It's an important point to note, how in last 5 years, from nowhere, we are now banking 1 in 3 of the richest Indians. We are the 3rd largest player in the wealth management space. 32 of the richest Indians bank with us. There are now about 9,600 families on our Burgundy private franchise, and we have 66% year-on-year growth. And we've been recognized by others in terms of what we're doing on the Burgundy private side. Again, there will be a presentation more which will talk about some of the other things. Look at the journey on the credit card side since financial year 18 and how far this franchise has come. We are doing about 1.6 million cards. Look at the numbers now. We are easily doing about 12 lakh cards every quarter. We have 14.1% period end market share, 390 basis points improvement in the retail card spends market share since March 19, and 72% increase in retail card spend. So this franchise is obviously now hitting, if you look at the incremental market share, if you look at the incremental issuances, if you look at incremental acquisitions, this franchise is now number 2, number 3, depending on how you look at it. But then the gap between 1 and 2 is no longer that large as it used to be. We believe we have one of the most comprehensive and the widest wholesale banking franchise. You know some of the data on the left-hand side. But again, you see a trend across various slides. We seem to be the first one to be embracing new technologies, new platforms to do things. So here you see we are first domestic trade transaction on GOI-backed blockchain platform. So it's important for you to know that. We don't become a best digital bank by just doing one thing. It has to cut across the entire franchise. And you will see this technology seeping in, and the embracing of technology and creating platforms which invariably take a long period of time across all our businesses, slowly, gradually. And that's the point I want to leave you with. Our market share on RTGS is 8%, on foreign LC market share is 11%. We today have 125 APIs across transactional banking products, and you might be surprised, 21% market share in BBPS, which is the Bharat Bill Payment System. Again, some of the awards are quite evident. We will showcase to you with some data on how our new platform is working and what some of the volumes are. I think you'll be quite surprised with what we show to you. We are focused on high yielding segments. I've talked about it. The data is right there in front of you. But again, the point I want to land is if you look at our small business banking, SME, and the mid-corporate book, it is growing at a rate which is 2 times higher than the overall growth rate of the book. 680 basis points improvement in terms of the overall contribution to the franchise. And this has happened in spite of pivoting to better quality. It is not at the cost of quality. The slippages, the NPAs in each of these businesses is way lower than what we used to have 4 or 5 years back. So we're not sacrificing quality or risk anywhere. It is just, as I said, if you were to think about Axis and saying, okay, you have 6% advances market share and you want to grow the business, why do you have to compromise on risk guidelines? You can work on customer journeys, your distributor journeys, your employee journeys, internal processes, go after customer segments where you're not present, come out with the right solutions, create the right tech platform. You can grow at a very fast clip for a long period of time. And that's exactly what we're doing. Because it's an important question, integration of the acquired Citi consumer franchise remains on track. We are hoping to finish the LD2 integration as promised to you in the first half of financial year 25. Just to give you a sense for what some of the senior employees of Citi are doing, we have showcased some of the big jobs they're running today and they're managing today. So just to give you a glimpse of what those jobs are, I don't want to go and repeat it. This is more interesting. If you look at the data, we have worked on, our obviously key area of focus is customer retention, synergy benefits, adopting the global best practices on both sides and controlling the attrition. But in terms of business, and because you keep asking us the question, we're trying to showcase some data to you. What we had assumed in our models first time when we came to you, and let's say that was 100, this is where we stand today. And that should give you the comfort in terms of how this business is performing. Or if we isolate this business, how is it performing? Data speaks for itself. There are some more details which I think we'll provide to you when Arjun comes and addresses you. I put a slide on HR because attrition is a topical thing today. We are the first bank, and again, you see, I always very strongly believe in the notion that you have to create your own path. We're the first bank who announced in June 2020 they're moving to 2-day rostering. We're still stuck to it. We are the first bank who came and, with account opening for LGBTI, BTI community. We have stuck to it. It's not that something which we push for ourselves. We are the first ones to launch GIG. We are the first in the banking system amongst the large banks where we launched something called Thrive. Everyone has an IJP, but the extent to which this IJP now encompasses the entire bank is very, very different. You can apply for a job after 18 months in a role. You can start applying at the end of 16 months. No one can stop you. You can go across various parts of the bank. And some of the data, since we launched it in April of 2023, we have shown to you. 2,600 employees have moved to a new role. 180 employees have been promoted. So we are promoting based on some positions, employees every month, depending on what job they do. And it is obviously working very, very well. Now, it's not that it's 100% success. We need to take it down to all parts of the organization. We need to ensure that for every position, many more people are applying. But people can see the transparency, etc., which we're bringing into the system. We invested in learning in a big way. People, when they talk about where the money is going, all the money you guys are spending. We did not have a learning and development program. We have launched it on a massive scale across every part of the bank. And we had 1 lakh learning hours in financial year 23. There's a 3x increase in what we call through micro learning. So we are continuing to invest in that space. D&I talked about that. They come as you are. Vibe, there are industry forums which we run where we get people from other industries to come and talk to us about what they're doing on the DI initiatives. I talked to you about the GIG, all kinds of awards we have won. On Glassdoor, we are the best rated in terms of advocacy, etc., etc. It's not that we're stopping there. We're working on the climate side too. We have announced our targets for from the ESG perspective. The first bank to obviously create the ESG committee of the board. It continues to function and continues to push us in a big way. Progress on targets is going extremely well. Let's see where we end up, and we might have to up the targets over a period of time. But this is what we had announced, and this is what we are doing. We have also showcasing to you our rating across various institutions. Dow Jones, FTSE for Good, MSCI, and CDP. So we are watching them. We are looking at if we are behind in 1 or 2 cases, in comparison to some other players. We are asking ourselves why we are behind, what do we need to do to get to that level, and how do we institutionalize some of those practices in the system. So it's not just a tick in the box. There is a real work happening in the bank on the entire ESG initiative. When you look at all the mega trends, we picked it up from all the great research reports all of you write, around rising affluent population, financialization, digital platforms, financial inclusion, and so on and so forth. And we see that all these things will hopefully support the financial services growth story in the next coming years. Do we have the platform, as I talked about the crouching tiger, do we have the platform to go and capitalize on those opportunities and take advantage? And can we use those opportunities to continue to increase our market share and change our market ranking in some of the identified focus segments for us? And you will see that we have created over a period of time very, very focused segments, focused areas, and how we are working on each one of them. And we believe if one axis was to come together, there are many, many possibilities. I can see I have only 3.5 minutes left, so I don't want to belabor the point, but we are watching all the trends. We are looking at ourselves and asking, do we have the platform to take advantage of those trends? And I just want to assure you that obviously we believe we have. Let me just stop here and open it up to...
Yeah, we have some time, so we can have some Q&A. Yeah, Suresh, please go ahead.
How does the new RBI regulations change the outlook for you?
See, we were growing at a certain rate. Obviously, it will have an impact on CD1, but apart from that, we do believe that there will be some movement on the pricing side for some of the loans which have come under the risk weightage. Second, I think the NBFCs and the fintechs which have been going gangbusters in some of these areas will get impacted more. So I don't know whether from a growth rate perspective will get really impacted. We are still assessing the impact because it's just too early. So we are looking at capital impact. We're looking at what prices increases we want to push into the system, which will help our overall P&L at some level. And third is we are obviously watching the NBFCs very closely and how they are behaving in the marketplace and what it means for us, whether it means more business or the same amount of business. It could mean more business.
Would you restrict supply to the NBFCs and to your partners?
We had always been, and again, when we do the other sessions, we had always been careful about NBFCs to start with. It's not that we are going and giving a lot of money to the NBFCs out there. I think this is obviously an opportunity for us to look at the pricing on the NBFC side. Yes, it's obviously we should use this opportunity to look at how much lending we are doing on the NBFC side. I don't think the change will be substantial. Both Ganesh and I see even our head of FI sitting there at the back. So I will ask them to reach out to you and have a conversation.
And finally, impact on growth. I mean, you have talked about the pricing, but do you think in the medium term there can be some impact on growth?
I think the RBI is very clearly hoping for growth to temper down a little bit. And I do hope the growth tempers down. If it does not, then RBI will do something more. It's obvious from the statements being made by RBI and the governor as of yesterday also. He talked about the fact that the banks and NBFCs should reduce their exuberance. I mean, that was the exact statement. So in that sense, we might see the overall growth temper down a little bit. From our growth perspective, I think we have always maintained a stand that we will grow at a certain rate above the industry. I don't think the industry growth rate, at least for the banking side, is going to come down substantially. So we should be in the same zone. I'm not expecting a big change in our growth rates.
Okay, thanks.
Maruk, before you, I'll have to go to Rinki because he beat you with the hands up because you are always first in the conference call. But here, so Rinki, you go ahead.
Thanks, Abhijit. And Amitabh, two questions. First is an extension, Rikin from IFL. So two questions. First is an extension of what Suresh asked. We spoke about growth and pricing change, but about the capital, right? So with this hit, we come closer to 14%. And especially with the ambitions of the growth that we have, what is the line in sand for you where you start thinking about the capital raise? That's number one. And number two, on the employee attrition, it's a problem for the entire system. We understand from the media reports that your interactions with the RBI suggest that there is overtly pressure on the market share grab and selling of products. With our focus on deposits and the market share in most of the other products as well, how do you intend to fix it?
So you asked me a question on capital. We have already said that we are grading capital, and in spite of this change which RBI has brought about, which will have a impact on capital, given the fact that we're grading capital, hopefully we'll be able to catch up with whatever we have lost in this process over a period of time. So we have today no intention of going to the market and raising capital. And Puneet, have I said that correctly? How you compare? I said that correctly?
Yeah,
He already has a mic. See, he's worried.
So I'll just supplement what Amitabh said. I think the way we've always thought about our capital is capital for protection and capital for growth. On the protection side, even after a prudent assessment of these guidelines, we're well above regulatory limits. We're also well above our internal re-raise threshold. Capital for protection also is on rating agency thresholds. So we are well above any threshold that impacts our domestic AAA. So we do not need capital for protection. Capital for growth, our house economist's view is bank credit should grow between 12 to 14% next year. Assuming we maintain our return ratios, we still have enough accretion for us to support our growth. Therefore, no plans to raise capital at the current moment.
And would there be a line in sand, like a 12%, 13%, where you think about it seriously?
He said that we have internal, clearly defined guardrails. If he wanted to share, he would have shared in his answer only, no. Lost some. Oh, sorry. Okay. Jenny is at work. On the attrition, let me answer the question quickly. Yes, attrition has gone up in the last couple of years. COVID times it came down and then kind of it went up. Some of the banks obviously and NBFCs are investing heavily, and so in the process kind of it's a merry-go-round. Attrition has started coming down and this year. I've told you some of the initiatives you talked about. We showed one initiative to you. It's an important board agenda which we discuss on a regular basis. We are seeing attrition come down in some areas which used to worry us earlier. But yes, on the branch banking side, especially on the acquisition side, we are seeing higher attrition and something which we are working on. It's a problem which will always be there. It's a question of how well you manage the problem, how many resources you put behind it, and what ideas you keep trying to ensure that people stay with you. Idea behind Thrive, for example, is rather than people seeking careers outside, we are saying seek it internally. Because we'll give you a chance very quickly to seek those careers. And when you get promoted, you get a salary hike also. Because invariably we realize that a lot of people at the junior level are leaving for that extra money. And for them, 3, 4 institutions, the brand name does not matter. It's about how quickly and how fast can I move from one to the next. And they're friends everywhere. So for them to come into a new institution is not something they worry too much about. This is the new millennial which you're talking about. So it is a problem. I'm not saying that it is sorted out. At a generic trend level, it has gone up. It has come down from that level, but it's still nowhere close to where it used to be earlier. and something which we're working on.
So obviously, your deposit growth has been higher than the sector, but then the PSUs have excess SLCR. Some of them still have, like the Bank of India's, etc. So for them, deposit growth was not really required. For private banks, the LCR was good, but lower than state-owned banks, so deposit growth needed to be faster. So what is your view on deposit growth? Because your deposit growth seems to be, of course, there's been an improvement in the quality of deposits, 550 basis points, but it seems to be a tad lower than other private banks. So what's your view? How does it shape up from here on?
So first is, let me answer the question more at a macro level. See, we need to decide what you expect from the what do you want the bank to deliver. If we are delivering 18% ROE with a certain growth rate, I think first you should look at that. Now, because I'll come to the deposit question in a minute. If you deposit is all you care about, we could have gone, raised our rates and delivered the deposit. Might impact NIM, ROE, does not matter. So, when you are trying to deliver an ROE, then you need to look at a combination of which businesses you want to be in, which businesses you want to grow, where you'll get better NIMs, what is the cost of deposits, what is the profile of those deposits, what is your overall cost of funds. You are looking at all those combinations, right? And you're trying to move each of these factors along in a certain way, because that optimal balance is important. So at a macro level, firstly, yes, we can go and dissect very quickly on the ROE and say this is what is lacking and this is what is lacking. But please judge us once in a while on the overall balance also, because we are trying to manage these 6-7 variables, and they tend to move in different directions depending on what you play more with. As far as deposits are concerned, we obviously all acknowledge that without deposits there is no bank. We do need to grow those deposits. We need to grow the right kind of deposits. We need to engage with the right kind of customers. We have a session where we can delve deeper into some of the stuff which we are doing. But please be assured that it was very important for us to change the way we went about seeking deposits. And one of the important elements there was that we were getting deposits. Overall headline number was looking good, but the outflow rates were high. So we worked on it, got it down. We have removed and stopped doing certain businesses you used to do in the past. That has had an impact on deposits. But overall, at the ground level, at the retail level, we are seeing green shoots, and they are only improving over a period of time. Now, it happens to be a tough environment. RBI has tightened liquidity. Overall deposits are growing only at a certain rate. So it has impact on all of us. But at the ground level, and Ravi will share that with you, we'll try to showcase to you some of the green shoots which you're seeing. It's an important thing which you're working on. It's not, we can ignore deposits because we're delivering 18% ROE.
Got it. And just one last question. So what would be your medium-term and your long-term kind of margin range? Because, deposit cost is staying stronger for longer. So
I'm not authorized to answer this question, but Rajiv will have something in his presentation. Puneet, yeah.
So Mahrukh, I think we've clearly indicated in the past that our structural through cycle NIMs will be 380. The NIM improvement that you've seen has led us to move from the 360, 380 to the 380 number. We are 31 basis points higher than our structural NIMs today. And please rest assured that we will do enough and more to keep as much of the cushion as we possibly can.
thank you.
Yes. We have 1 minute.
Go up to the last question, please. Then we can move on to the next session. Yeah. Give the mic to him.
Thanks, Chintan from Autonomous. Continuing on deposits, if we look at Axis, over the last 5-7 years, it's always paid up a little bit more on cost of deposits than your kind of two main peers. Do you see that gap converging? Today it is lower than it has been in a long time. With the focus on the quality of deposit, type of deposit, do you see that gap converging sustainably?
Muh mein ghee shakkar, boss. Please go and look at our rates.
They are closer than they have been in the past.
So it's a journey we are on. I mean, that's what we keep saying. You change too many things at one go, the system can collapse, right? I mean, you are gradually, slowly changing people working in a certain way, and it has to be done in a staged manner. In the last couple of months, at the retail side, the gaps have been brought down to practically zero. Those gaps don't exist. Now, it will take time for it to reflect in the stock. And obviously, we have to watch what our growth rates are. and we're watching it very, very closely. And it is a change and it's a transformation for people on the ground, because earlier maybe they could be going and selling a deposit saying my rate is higher. Now they cannot say that, and they have to win on relationship and being in front of the customer. It is a change. And it takes time for it to settle down. Same thing, we are looking ourselves and asking ourselves the same question on the corporate side. How many of our deposits are we giving a special price, where we're not giving, and why are we giving the special price? And that pressure is on also. So, but it's a gradual change. It cannot be, because on one side you're saying, okay, these deposits you cannot get, sorry, not interested. By the way, these customers you're getting, all of them are out, or you will go and increase in pricing. Oh, by the way, NRI, that is also out. Oh, by the way, when you keep making all those changes, it has to be slow. It can't be sudden. Yeah.
Fair enough, but
Yes, so you will see this gap come down. Yeah.
you think so, okay.
We've already done it. So as I'm saying, that proof of the pudding is eating. Yeah.
Growth rates have slowed down recently as well. I'm just wondering whether there is a connection.
No. So we have been making changes all the way through. Yes, while doing this whole project on the deposit side, we have been tightening our belt in some of these practices. It does impact. We have not measured how much impact of this is, but it does impact. But we are willing to live with it and bite the bullet, because unless we do that, the way a franchise thinks about things will never change. So we have to keep doing it.
Fair enough. Yeah. And on capital, the last one, fair enough that you mentioned that you've got internal thresholds and you're above growth and protection levels. But, as investors look at Axis versus its peers, does that come into your thinking as well? Or does the capital, the CET1 ratios for India need to come down because they are at very high levels for the other banks?
So obviously, when we discuss capital with our board and internally, we look at where others are at and what the differences are. And it also has impact on our ROA, numbers and so on and so forth, because that free capital feeds into ROA too. We obviously watch all of that. But at the same time, we are cognizant of the fact that just going and raising capital for the sake of it, when we really need it, also something which we should be wary about. I think some of our investors, or some of you, do blame us for raising capital at the wrong prices in the past. So we have to balance both. Today, we feel very strongly that where we are on capital, and because we are accreting capital, there is no need to get caught up in this, that, because there is a difference, let's go and raise capital. So today we are very sure, no raising of capital, we'll continue to accrete it. And as we continue to accrete at the growth rates which you're all talking about, and with RBI what they're doing, hopefully the growth rates only come down, not go up, we should be in a comfortable position. That's where we stand.
Thank you.